Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during the show. That certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme, miscellaneous trivia. Now today, this is the first time we've ever done this before, but last week we had Rob Napolitano on of Grit Partners, and it was so much fun and there was so much to cover that we only covered about half. So we're having him back on. Welcome, Rob, to The Best of Investing.
Edward, thanks for having me back again. It was a lot of fun last week, so I'm glad we were able to do this again.
Yeah, no, it's terrific, and for the audience who didn't listen in last week, I'm going to go ahead and read your bio here again. So first of all, the title of this show is "How to Profit in a Downturn Economy and Protect Your Family's Future." Rob Napolitano is topping Goliaths and stewarding people through the biggest wealth transfer in history. During the Great Recession, Rob filed for bankruptcy, battling 2 behemoth banking institutions, and came out of bankruptcy with a higher net worth than when he went in. He went on to law school, learned the inefficiencies of the system and how it worked. After gaining a full understanding of how the financial system works, he and Grit Partners are now helping people grow their wealth and stay protected during this distressed economy. Grit Partners harness a non-traditional approach for accredited and qualified investors with something different. A private investment firm tied to some of the largest and most trustworthy institutions in the industry, providing unmatched access to distressed financial opportunities in real estate, private lending, and life settlements not generally obtained by the general public. Yeah, we were talking, I remember last time we were talking a little bit about this life settlements. They used to call them viatical settlements, but that may be a little different, right?
It's, in the end, it ended up being the same thing. The viaticals had a connotation, a negative connotation, many years ago, because what was happening, like in any business or investment atmosphere, there's always some nefarious players doing some things that aren't so nice. And so what was happening, and this happens in real estate investing and in banking as well, was straw buyers, right? Where someone wants to get a loan in somebody else's name or didn't qualify, or hey, you mind taking my $5 and going aside and buying me, a pack of beer. I'm not old enough to buy the beer, but you mind taking my money and going in, this kind of stuff. And so viaticals was a similar type of practice where they would take out life insurance policies on other people, or they would take it out just so they could sell it right away and make some money on it. And so it was this practice of really not using or trying to usurp the purpose of life insurance.
Well, yeah, because you have to have a vested in. I've had my life insurance license since 1984, so I remember you have to have a vested interest, and I think that came out. I think it was, if I'm not mistaken, in the 60s or 70s. Unscrupulous insurance guys were getting bums off the street. Like I said, here's $5, sign this, you got a life insurance policy out on you.
And it's you bring up a great point. It's about having a vested interest, and that's the bottom line. You have to have a vested interest in these things. So when I went through my bankruptcy and started opening up all these mortgage-backed securities and how these banks were doing all this, it was interesting because what I found was this thing called a credit default swap, where the investment bankers would take out this credit default swap, which essentially acted like an insurance policy.
Yeah.
And I remember the arguments that would go back and forth. And here's a great way that I heard one senator describe it. And he said, and take this story. He goes, the story is, if let's say you wanted to ship some valuable goods across the seas, and you pay the shipping company, you pay and all that stuff to go across, and you take an insurance policy out on making sure that it makes its voyage, right? And so it makes its voyage. But what happens when you call your cousin who owns, his own little fleet with a nice big cannon on there and go and sink the ship? and now you force the ship to go to the bottom and you collect on the insurance. Well, that's what happened with the subprime crisis, where these bankers were insuring all these loans, but then made sure that people could pay back these loans just so they could trigger the insurance, because they were getting paid more money on the insurance trade than actually getting paid back their actual money on the loans.
Well, we're going to cut to a break. When we come back, I do want to talk about a little bit about the credit default swaps, because I was involved with it as a borrower, and it wasn't the worst thing in the world, because I had to finally kind of understand, and we'll explain to the audience that, because it's kind of an interesting story. I try to make things, complicated subjects, really simple. All right, we're going to cut to our first commercial break. Here is our first trivia question. And again, if you, just as a reminder, Rob, if you know the answer, don't say anything yet. In what country did the first Starbucks open outside of North America? That's our trivia question. 888-912-1190. First caller with the correct answer wins that Danning certificate, which is worth over $100. Stay with us. The Best of Investing will be right back. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with my special guest for 2 weeks in a row, Rob Napolitano. Our first trivia question was, in what country did the first Starbucks open outside of North America? Any answer? Any idea? No?
I want to say it's I'm going to take a wild guess and say it was somewhere in South America. It had to be.
One would think, but no, actually it was Japan.
Oh, really? Because the other options would be,
I know the big tea drinkers, but yeah, the coffee drinkers, whatever. Hey, want to make a mention here for SF Bay Adventures. How would you like to sail across the bay in San Francisco? They have the Frida B schooner. It's very kind of an interesting. It's not a big cruise ship. It's more of a sailboat. Check them out, sfbayadventures.com. All right, so we were talking just before the break about these credit default swaps. And I remember back in, I want to say 2008, something along those lines. I was looking to, I had a loan on my building, and my banker comes to me and he says, Edward, I want to introduce you to like someone in the credit department. He goes, I'm not familiar with this, so I'm going to sit in on the lunch. It'll be the three of us, and we're talking about refinancing your building. And so he's starting to explain to me, credit default swaps, but he's using terminology that's like really, really basic. And I remember looking to him and I said, listen, not to be disrespectful, but I said, we only have an hour for lunch. I said, you talk as sophisticated as you can. Of course, acronyms I may or may not know. And I said, and I'll stop you if I don't know anything, right? And so when he gets through this big chart and all this kind of stuff, I said, wait a minute, if I understand it correctly, effectively, what will happen is if interest rates go down again and I refinance, I basically am going to have a big prepayment penalty. He goes, yeah, that's about it. I said, okay, well, that makes sense. I don't think rates are going to come down, and it's funny because rates actually did come down even further, because we all looked at the table and we said, we don't think rates are going to come down. Well, we were all wrong. Rates came down. And when I refinanced again, it cost me $200,000 to refinance. Wow. But I got a good rate, and it stretched it out for another, 5 years or something. But yeah, this is good.
And that's what these, right? That's why I said to keep it simple. That's what some of these contracts are. They're just there to insure against risk. And the risk of the interest rates coming down was the risk at the point right there and then, right? The example that I used was the risk of the voyage going across the seas. Will your product make it across the seas? There's a risk. And that's all insurance does, is insures, and it's a bet. If you think what's going to happen is going to happen, you take the bet. If not, then you risk it. It's just betting.
Exactly.
Whether you want to take that risk or not.
Yeah.
That's all it is.
Good. So let's talk a little bit about this. We in the introduction, we were talking about how you're providing unmatched access to distressed financial opportunities in real estate, private lending. But we'll talk about that. What are these unmatched access to distressed financial opportunities that you have?
Well, it actually ties into what we were talking about with the insurance. We have access to mortgage debt, as I understand you do as well.
Yeah.
But one thing that we are doing, that I'm not sure if you are or others are, is that we are tying our assets to insurance policies as well, so that we are offloading the risk in investing in these loans onto the insurance. So by tying the two together, we've created our own proprietary, for lack of a better term, our own proprietary credit default swap, where we can hedge against some of the risk in buying these loans. And we can offer better performance than most others out there, because we're doing the life settlements along with it and tying them together.
Well,
So
now
it's something
life
new and
settlement,
unique. We came across with.
but now life settlement though, you're talking life insurance, right?
Yeah.
So how would this work? Let's say, let's take a look at it from the borrower standpoint and from the lender standpoint. So I come to you and I say, I want to borrow, 100, let's make it simple, $100,000, and my property's worth 150. I mean, is that about the kind of ratios we're looking
Well,
at?
it would be more for those that want to invest and put money to work on the lender
Okay.
side. So those that want to participate in buying some of these loans at deep discounts can participate with their capital, and then we will have available the optionality to insure against loss of capital.
Okay,
So
okay, that part I'm really interested in. We got about another 40 seconds before we have, these times go very quickly. So how do you, okay, so let's look at it strictly from the lender standpoint. I want to invest $100,000. And are they one-off loans, or is it in a fund?
no, we do it through our fund. We do it through our fund. They're both funds, and
Okay.
we tie the two together. And so when you putting your money at risk in
Okay.
these funds, it's the same as we talked about before. You can have the optionality to buy some protection against downside risk.
Gotcha. Okay, which is interesting because their fireman's fund used to insure second mortgages back in the 70s here when interest rates were really, really high. They got smoked because the person putting the stuff together, he was unscrupulous. Unfortunately, he ended up landing in the pokey. But unfortunately, I think insurance companies threw the baby out with the bathwater on that. And yours is probably a lot different. We're definitely going to talk more about this when we come back from our second break. Second trivia question. Where were the Declaration of Independence, the Constitution, and the Bill of Rights stored during World War II? Where were they stored? Call 888-912-1190. First caller with the correct answer wins the tanning certificate. Do you think you know this one? Okay, don't say anything yet. All right.
Know this one.
All right. Stay with us. You're listening to The Best of Investing. Don't touch that down. We're going to be right back. Welcome back to The Best of Investing. One more time. Edward Brown here along with Rob Napolitano. Second trivia question. During World War II, where were the Declaration of Independence, the Constitution, and the Bill of Rights? I assume these are the original documents they're talking about, because who cares if it's a copy, right? Where were they stored during World War II? Rob?
If memory serves me correctly, it was with the Biltmore family, and I believe it was in their estate in North Carolina.
That's not the answer I have. Now, maybe I'm wrong, but Fort Knox. They're actually stored in Fort Knox.
I could be wrong, but as I went through the Biltmore not too long ago, they tell that story of how
really,
and it may not have it may have been other valuable possessions of the president, maybe, but I knew there was something really of value that the Biltmore family came and said, we'll hold that until the war's over and we'll take care of it.
Yeah.
But I don't remember if it was those documents or if it was something else. So you could be right.
Well, okay, we'll have to do some research on that. Okay, so I want to get back to what we were talking about here. Oh, actually, we want to make a quick mention here. Palio Restaurant in San Francisco. They did some remodeling a few years ago. They were voted like best restaurant in San Francisco, and there's only like 3,000 restaurants in San Francisco, and that was voted by the locals. So it's got to be good. And I've been there before. It's fantastic food. Palio Restaurant. It's pretty much very close to the heart of downtown financial district in San Francisco. Check them out. Palio, Palio Restaurant. Okay, so going back to, I'm an investor. I want to invest $100,000 in your fund that does mortgages. And are you buying discounted mortgages, or
we're buying the discounted mortgages? Yeah.
Okay.
And so I wanted to make that clarification from before too.
Yeah,
we're not insuring the properties or the mortgage. we're insuring investors' capital.
No, that's more important because people are always going to get fire insurance and that sort of thing to protect the property.
Right. Not
Okay.
hazard insurance, not property insurance that we're doing. This is investor
Investor
risk.
Okay, so what's the average loan to value? Or I should say investment to value because you're buying it at a discount. So
we're very rules based in how we built our portfolio. So our investment to value is we won't go up more than anything above 65 of BPO or appraisal, or for I'll use generic of value of the property. Nothing above 65% of the value of the property we won't buy.
okay, is that the unpaid principal balance, or the unpaid principal might be higher, but you're buying it?
Yes.
Okay, okay, gotcha. So make it simple. $100,000 property might have an unpaid principal balance of 80,000, but you're going to pay 65,000, no more than 65,000 for that.
5,000 of the 100.
Gotcha. Right. Okay. And if I invest $100,000, with, obviously there's no guarantees on anything, but from the standpoint of what the rate, basically, what can I expect? I assume a monthly check.
So it depends, right? So we have different options for different investors depending on what they're trying to accomplish and what their goals are.
Okay.
We do have options for people to come in who want to get a monthly check. Their returns are going to be correlated to the risk that they're taking, because those are really going to be note holders and they're going to take less risk, and so their returns will be commensurate with that. But those that want to take more of a growth approach and more of an aggressive approach, we can put them in profit sharing mode and buying some of these loans alongside with us as partners, and they'll get bigger returns, but appropriately taking more risk with us, which again is why they also have the optionality to insure some of that risk as well.
Are these performing loans or non-performing?
They're both.
Oh,
they're both.
okay.
So the strategy is, so we break it down. Our strategy is simple. There's probably about 30% of our business where we're trading in and out of loans, doing that. And then from that, we'll extract non-performing loans for the majority of what we will extract, because we can also add on actual properties, performing loans, commercial loans, and things like that.
And that's where the growth potential comes in, because you may foreclose and get a bonus.
Right.
Okay, so if I invest 100,000 and I want to be, a little old lady, so to speak, and get a monthly check, what kind of distribution rate are we looking at?
So I don't know that I would actually take that person on, but because honestly, I look at suitability.
Well, I use the term "little old lady" just
yes. I definitely look at suitability there,
because you have to be an accredited investor, I'm sure. Yeah.
Well, besides just being accredited, you got to understand that this. Let me back up a second. I want to get to your answer, but I want to put my logic as to why I'm saying what I'm saying. Okay. One of the biggest reasons why we have distressed credit and distressed mortgages, or any kind of distressed debt, is basically because it's a mismatch between the capital strategy and what it's supposed to be used for and the capital terms. It's a mismatch because you really do have to match the strategy. In other words, you're not going to have someone who wants to live in the house for the next 20 years and put a hard money loan on it.
Correct.
Right? And you're not going to use conventional financing to do a fix and flip. So the capital terms have to actually match with the actual strategy and the use of the properties. And it's in the mismatch and people not understanding these terms, they get themselves in trouble. And so when you present that, hey, we want someone who wants a fixed income payment because they're later on in years, our fund is not really matched up for that, because we'll pay out more in lump sums and it goes in roller coasters where, it's not going to be a steady stream. We'll get lots of money in, and then we'll just dry up for a little period, and then we'll get a lot more money.
Yeah, because there'll be some principal distributions.
And so it's not really the right match just to get someone who wants that fixed income. Okay,
well, before we get to break, let me make it really kind of simple. What for the person who's trying to be ultra conservative, let's say, what kind of rate of return should they hope for on that side of the equation?
With what we're doing, between 4% and 7% on an annualized basis.
Fair enough. Okay, tell you what, we're going to our third trivia question here. Who was the first televised president? Call 888-912-1190. First caller with the correct answer wins that tanning certificate. Don't touch that dial. The Best of Investing. We'll be right back. Welcome back to the Best of Investing. Edward Brown along with Rob Napolitano. Here's our third trivia question. Who was the first televised president? It was not George Washington, I'll tell you that.
I'll guess FDR.
Yes.
All right, good. All right, there you go.
All right, and as I always say, if you you got 1 out of 3 at least for sure, we know maybe 2 out of 3, and 1 out of 3 gets you in the Hall of Fame in baseball, so that's not bad. So we want to make a mention here also for the Gym Guys, which is a company where the gym comes to you. You call 888-GYM, G-Y-M, and then guys with a Z, and give them a call and check them out, because rather than you going to the gym comes to you. Kind of a neat idea. All right, so Rob Napolitano, we got one more big segment here. It's 7 minutes long. So you're raising money, and you're pretty much diversifying this portfolio, because you're buying discounted notes as well. On the discounted notes, well, how the ones that are performing, and you're paying 65 up to 65% of the value, where the unpaid principal balance is somewhere in between the fair market value and the amount that you're paying because you're buying at a discount. What kind of current yields are you seeing?
So we're not buying the performing loans at that number at 65. When we're buying at 65, those are the non-performing, right? You're buying the hairy ones that have problem stuff, and we're going through the modification process to get people back on track.
Okay.
With that. And so when you talk about that, it's interesting, because yield on a particular deal is not just interest rate. You're also getting it from a discount, and it also is going to depend on how long of that turnaround is. And that's also going to depend upon which state is in, because turning things around and doing workouts with people has a number of variables that go into it. So you got the time factor in there, how much of a discount, plus what kind of interest rate you're going to get on there, and you blend all that together. So it's hard to say for one, but in general, what we've been able to do is to perform at a 12 to 14% annualized basis for the last 7 years. And as we said, except for COVID, we took a dip in COVID, we got into the mid single digits, but then pops right back up after COVID with all the bottlenecks and all the backlog, everything moving through the court systems catching up.
And for the audience, the fancy term is called accretion, which is where the discounting gets accreted over time. And yeah, we tried to explain that to people too, where it's like, look at, if this performing loan performs exactly as it's supposed to for the next 15, 20 years, whatever's left on the loan maturity, because you can't force someone to pay off early, you're going to get, a 9% return or whatever it is. But if they, die or sell the house or whatever, or just come into money and pay you off, it might be 12, 15, 18. We actually bought for our Southwest fund, get this, we bought a performing loan at a yield of 116% annualized. For whatever reason, the seller, and we were buying loans that were seller carryback loan, primarily in Texas. So this person owned a note, and they were willing to get less than, there's like 10 months worth of payments. It was just ridiculous. It's like, really? I mean, it wasn't a lot of money. It was like, less than 10 grand, but but still over 100% return. That's not bad.
No, it's out there. And I look at this as, I try to put this picture in my head and make it easier for people to understand. And I use the analogy of football, because it's easy to measure the gridiron, right? And so let's say your team is moving downfield. Now, you'll remember this. Do you remember a gentleman named Refrigerator Perry?
Of course.
Of course. Everybody remembers the fridge, right?
Fridge, yeah.
Why was he such a great utility player? Because when you got down on the goal line and you needed a hole made, boom, the Perry comes in and he would just make that hole and score every time, right? Yeah. And so our business is similar to that too, where when we're all investing in distressed assets, it's because people can get only so far And then you can pick up a $10,000 note at 116% yield just to get the last goal line piece, grab it at the end, take it into the end zone, score the points, and get all the accolades, right?
I didn't quite think of it in terms of refrigerator Perry, but yes.
But that's our business, right? People try to take it the distance and can't take it the distance, and then we step in. Your guys, our guys in this business, that's what we do. We step in the end, take it a distance, and get all the accolades and get all the awards for doing so.
Yeah.
That's what Refrigerator Perry got to the Hall of Fame. Why? Because boom, he would just create that hole.
You know, it's funny. I still remember. It's funny. That was one of the few times I actually went to Vegas to go watch the Super Bowl, and you know, to me it was like shooting fish in a barrel. There was like no way that Steve Grogan for the Patriots was going to do anything for the '85 Bears. And I remember placing a $500 bet, which was a lot for me back then, right? And just it's like I don't care how many points I have to give to the Patriots. You know, the Bears are just going to smoke them. And while I'm doing the bet, I think I only had to give up like 7 points. I asked the guy who was taking, you know, the cashier, I said, I'm just kind of curious. I said, what's the biggest bet you've seen so far? He goes, well, the guy just before you put $50,000 on the Patriots. And I go, oh man, is he going to be unhappy? And you want to hear something funny on that? That was the first time that they had a situation where you could bet on anything. And they like literally you could bet on the coin flip. And what happened was that was the year. The guy flips the coin, and the announcer goes, you know, on TV, and it's heads. And I hear a bunch of people because I'm watching for, you know, like there's 1,000 people watching this game, right, in Vegas, and people are yeah, and you see a whole bunch of them leave to go collect, and then they come back from break, you know, and the announcer says, you know, I don't know why I said heads. It was actually tails. And then you hear a bunch of and those people collected. So Vegas said from then on, nobody collects anything until the end of the game when we know for sure because Vegas. That's the one time Vegas lost. They lost on both sides of the equation. All right, stay with us. The Best of Investing will be back with some closing comments. Don't touch that dial. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with my special guest, Rob Napolitano. No trivia question this time, but Rob, what do you see as the biggest mistakes that investors are making that is preventing them from hitting their goals?
Wow, that's a loaded question. I can go down a couple of paths. I'll tiptoe on a couple of them, treetop on a couple of them, and I'll go deeper on one of them. I think as investors, one of the biggest things that hold us back is our own personal limited beliefs and our own ceilings that we put for ourselves. We don't think we're good at it. We don't know if we're good at deciding who we want to invest with, what we want to invest with. So limiting beliefs. I think another big mistake is a lot of investors put too much on the upside and not enough analysis on the downside risk, and they don't do enough risk analysis and risk mitigation analysis. And so to that point, the easiest thing to say is I think too many people play offense and not enough defense, and you win in these games playing offense and defense simultaneously.
They say you make money, like when you buy a property, they say you make it when you buy it because you got to buy it smart. And
that's right.
Yeah.
And that's why I like to look at things from the risk side. So I come from the banking side or the mortgage side, right? Remember when we did banking before all the subprime stuff happened? I was taught that the answer is always no. And the data will move me to a yes. Or if it doesn't, then we stay at no.
That's the same thing. My accounting background is the same thing. When someone says, hey, do you think I should invest in this? No. You know,
let's not look at everything and see if it gets to a yes.
Exactly. And Rob, before we forget, how do people get a hold of you if they want to check out Grit Partners?
So the easiest way to get a hold of us on our team is, as we said last time, we're trying to push forward where people can, as opportunities or windows of opportunities are closing, and we want people to capture there tomorrow, today. So we want to be brilliant at it. So they can email us at brilliant@capturingtomorrow.com. That's brilliant@capturingtomorrow.com. Once they start writing it in an email, they start manifesting it that they become brilliant at capturing their own tomorrow. So brilliant@capturingtomorrow.com is where they can reach us.
I like that. And like you said, you came from the banking. What made you shift from your old profession of banking?
Goes back all the way back to my backstory about I had my own mortgage bank. I was doing $40 million a month in closings and stuff. got hit by the subprime crisis, wasn't prepared for it,
Yeah.
lost all of it, came back from the other side, and saw what the banks were doing to the people in foreclosure. And I said, I want to get back into the banking side, but instead of originating, I want to move up the food chain. I wanted to own the paper, control the paper, and be more of a decision maker on how these outcomes work out. So that all fed into my experience, into going into distressed markets, downturns, and really excelling in the downturn, because I love the adversity. I love the ingenuity of it, the chess match of this business.
Well,
Strategy of it.
I love the fact that you didn't just say, well, this thing didn't work out, so I'm going to, go become an engineer. So, you know what I mean? It's just like, no.
Yeah,
We want because I've had good success in real estate and bad success, but I still realize that there's still something here. And I think you're the one who said, own nothing but control everything. You said that last week. I go, that I really like that, because it's so true how the bank really does control. And again, depending upon what states. I mean, there's certain states that we avoid because it's just too hard with foreclosure laws. In fact, on our Southwest fund, we don't buy. I don't think we have any California ones. We do have New York, which is a hard state, but if there's enough equity in it, it's always worth it. Rob Napolitano, stay with us. We're going to go to our thoughts for the day. Thank you very much again for being our guest. Did you hear about the claustrophobic astronaut? He just needed some space. And I started investing in stocks, beef, chicken, vegetable. I hope one day I'll be a billionaire. I thought that was pretty good. I like that one. All right, tune in next week to the Best of Investing. We're going to be giving away more free prizes for answering trivia questions and, of course, having more dad jokes. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.